Welcome to this YouTube channel. In this video we are going to talk about how rich people get richer. Before starting this video, like this video and subscribe to our channel for future updates. The wealthy become even wealthier. It's an unavoidable truth of life. Is that the case? Is it true? Or is it simply another one of those things that people say? Existing research suggests that, despite rising incomes, the wealth gap is widening. And the pandemic is unlikely to help. Detailed wealth data, on the other hand, is extremely scarce. However, one specific Norwegian law aided the situation. Affluence breeds affluence. This simple concept of privilege has exacerbated growing dissatisfaction with inequality, which has risen in the wake of the COVID-19 pandemic. Wealthier people are more likely to earn larger returns on their investments, according to a research co-authored this year by economists from the IMF and other institutions. It also indicates that, while wealthy people's offspring are more likely to inherit their parents' wealth, they aren't certain to generate the same high returns on investments. Detailed wealth data is hard to come by. But 12 years of tax records from Norway, 2004 to 2015, have offered a fresh window into wealth building for individuals and their descendants. To avoid self-reporting inaccuracies, the Nordic country has a wealth tax that forces employers, banks, and other third parties to register assets. It is also feasible to match parents with their children using the data, which is made public under specific conditions. According to the data, a person in the 75th percentile of the wealth distribution, who invested $1 in 2004 would have received $1.50 by the end of 2015, a 50% return. On the same invested $1, a person in the top 0.1% would have received $2.40, a return of 140%. Another important conclusion is that high returns both propel people to the top of the wealth scale and keep them there. Moving from the 10th to the 90th percentile of wealth distribution raises the probability of making it to the top 1% by 1.2 percentage points, compared to an average probability of 0.89%, after controlling for age, parental background, and incomes. Why do the wealthy make such large sums of money? Richer people, according to conventional opinion, put more of their money into high-risk ventures, which can provide bigger returns. However, our study shows that even on more conservative investments, wealthy people generally receive a larger return. Richer people get pure returns to scale on their money. Individuals who are wealthier are more likely to obtain higher risk-adjusted returns for a given portfolio allocation, presumably because they have access to unique investment options or superior wealth managers. Financial intelligence, financial data, and entrepreneurial talent are all essential factors. Because of these features, wealth returns are stable over time. This is the first study to quantify this mechanism and demonstrate that it is likely to matter in practice. Is it true that high returns are passed down across generations? Yes, but only in a limited sense. Although there is a strong intergenerational link in wealth, there are significant disparities in how wealth returns accrue over generations. The offspring of the wealthy are likely to be wealthy, but they are unlikely to benefit as much from their money as their parents did. This implies that, while money can be passed down through generations, outstanding skill cannot. Wealth is one of the most divisive topics in the world. Everyone has an opinion on how it should be distributed and what is wrong with society, such as how some people have too much money and others do not. Regardless of your position on the issue, one thing appears to be certain: wealth breeds wealth. It's not just a myth. According to a new study, the wealthy really do get richer and stay wealthy. Economists from the IMF and other organizations reviewed 12 years of tax records from Norway in a new study, providing an unprecedented look at how wealth changes over time. The information was made available because Norway has a wealth tax that requires assets to be declared to third parties in order to avoid mistakes. Researchers were able to evaluate statistics from 2004 to 2015 because the data was made public under particular conditions. The evidence demonstrates that the wealthy do indeed become wealthier, and this is due in major part to increased investment returns. Norway is one of the world's wealthiest countries, hence the majority of its citizens are well off. However, the wealthier people were in the beginning, the wealthier they tended to be later on, If someone in the lowest quarter of the population had invested $1 in 2004, they would have received an average of $1.50 by 2015. That's a 50% return in 11 years, which isn't terrible. However, someone in the top 0.1% would have $2.40, a 140% return. Another significant discovery was that persons at the top of the wealth scale do not appear to fall from their position, even after researchers adjusted for individual, background, and other factors. To put it another way, it's impossible to go to the top of the wealth scale if you're not already there. There's money, there's risk, and there's a wealth tax. So, why is there a difference in return? Richer people, according to conventional belief, can afford to take risks and profit from them, but this does not appear to be the case. Richer people, on the other hand, may be exposed to unusual investing opportunities or be able to afford wealth managers. According to academics, financial education, information, and relationships are equally crucial, and high status provides you with all of these things. The wealthy status appears to remain stable over time, even across generations. According to the study, rich people's offspring, on the other hand, often do not enjoy as high a return on their money as their parents did. Wealth, it turns out, can be passed down through the generations, but skill and aptitude are not. Of course, there are substantial drawbacks to this research. It was conducted in Norway, so the findings may not be applicable to other parts of the world. But here's the thing, Norway is one of the most progressive countries in the world when it comes to taxation. A 0.85% net wealth tax is imposed on a person's total wealth in the country, all the assets they own, regardless of where they are situated. The tax is imposed on net worth exceeding $170,000. To put it another way, if Jeff Bezos and his $182 billion were Norwegian, he'd have to pay $1.5 billion in taxes each year solely on his fortune. Elizabeth Warren, a 2020 Democratic presidential candidate in the United States, also backed a wealth tax on the ultra-rich, which was declared unconstitutional in the United States. But here's the thing, the wealthy in Norway grew even wealthier as a result of the wealth tax. This is surprisingly consistent with what Warren's supporters claimed, that while a wealth tax would not prevent the wealthy from becoming even wealthier, it would do so at a slower rate and in a fashion that would benefit the rest of the population rather than causing excessive economic disparity. The idea of a wealth tax in the United States would apply to billionaires in its most common version. Despite its flaws, this study is consistent with previous research. Although there are few studies on income inequality, they appear to suggest that anytime wealth is created, the vast majority of it goes to the top 1%. Economic inequality, which is on the rise in many regions of the globe, is more than a moral issue. It's been linked to a higher crime rate, slower overall economic growth, and the market's tendency to jump from bubble to bubble. According to a recent study, economic disparity leads to increased instability and possibly terrorism. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.